Reporting a 0.4% rise in revenue today as the building materials supplier also maintained its gross margin percentage. However, on the bottom line, we saw the company moving into a loss per share of 30 cents per share. So here to unpack the numbers, we've got Eugene Beneke. He is the CEO of Iliad. Thanks for joining us today, Eugene. It's been certainly a tough time for anyone who supplies into the building sector, and we've seen that reflected in these results on the bottom line. But just talk us through, because it is interesting if you do look at those numbers there. You've got that gross margin, which was positive, and it's really the impairments you've had to take as one of the factors that led to the ultimate bottom line loss in the company. Just take us through that.
Yes, the loss is directly attributable to the portfolio adjustments we've made. To your earlier point, the marginal revenue growth is reflective of the fact that the industry remains very challenging, and under those circumstances we're pleased to have sustained the gross margins. And expenses is always a controllable, up 3.7%, which is well below inflation. So that results in negative leverage. But ultimately, the big impacting factor on this result is the portfolio adjustment, which, as far as we're concerned, is a culmination of various strategic initiatives that we've implemented in order to reposition the business. And this portfolio adjustment effectively solidifies our foundation. The loss makers are effectively out of the business.
So the loss makers are out, but you have had to take a hit through those sales right now. But let's talk about where you're making money and where you're not managing to generate top line growth. Because if you look overall across the group, you see that flat growth there, and that of course is being countered by some expenses growth. So tell us about various products where you are seeing growth potential and the areas of the business that still is lagging behind.
Well, we have a national portfolio, and so in certain regions we do see some good activity, inclusive of the Eastern Cape as well as the Free State and the Northern Cape. In terms of segments of the industry, definitely still reasonable activity levels in the additions and alterations market, your typical DIY customer. The contractor segment of the market, credit, where we have a strong presence in, has been under pressure. But we do believe that some of the changes we're making, inclusive of having completed the Buco launch, which we will now support with a significant national marketing campaign for the balance of the year, that single identity positions us to benefit from any gradual growth that may come from the market in time to come.
Yeah, is that going to come anytime soon when it comes to supplying to the building materials space? Are there specific aspects also of the market where you are starting to see those green shoots or some positive growth coming through?
Yes, we do see building plans passed going into a positive direction. However, converting a building plan passed into completed requires the confidence and the ability to access finance. Some of the businesses in the metropoles are performing quite well. The rural areas, on the back of some of the well-documented challenges with unsecured lending, has felt some pressure, disposable income of consumers under pressure. So we found the areas in the far north and the Limpopo has been under pressure.
So it's the lower LSM groups that you're starting to see the most affected when you're looking at the income groups, if you look at it like that?
Yes, the rural markets has been sustained for quite some time. The subdued market conditions has been with us for a couple of years, and only in the last few months have we seen the pressure convert into disposable income not being at the levels that they used to be. But thankfully, we benefit indirectly from infrastructure spend, and in areas where infrastructure spend takes place, roofs follow that, houses follow that, and ultimately we need houses, we need offices and warehouses, and the growth is there, albeit gradual. There's no exponential growth around the corner.
Everyone's saying they're still waiting for government infrastructure spend. The last thing I'd like to touch on, debt, 134.8 million rand, it has ticked up. In terms of financing going forward, is the company able to do that through cash flows that are being generated? Because you've also had to raise, one of the factors that you need to consider is that you're raising debt and to work into working capital. So is this something that we need to be concerned about?
No, not at all. We've been spending significantly for the last 2 years on significant projects, including the revamping of our stores as well as the IT integration. It took quite a bit of capex investment. Of course, having repositioned the business and adjusted the portfolio, the remaining portfolio needs to kick out the cash profits required to pay the free cash flow, and we're comfortable it will be able to do just that.